Dear class, let us today discuss effect of changes in the foreign exchange rates. Uh, in a modern business, uh, business normally want to go to sell or buy or import or export with other organizations which are found from other countries. And this gives rise to organization trading with more than one currency. But also, it is obvious that exchange rate normally changes every minute or a day. And this brought the organization into a currency mix-up that require the standard to give a guidance. Normally, the business go global in a two-way. The one way is where we have individual transaction in foreign currencies. Individual transaction, it might be we sell goods to other country or we buy goods from the other countries. And if we buy those goods in other country and we are to pay later on, then this will give rise to debtor or to creditor that are denominated in other currencies. But again, it might be setting up a foreign operation that you have a branch that are in the other countries. So the objective of International Accounting Standard 21, it gives guidance on how to include a foreign currency transaction and a foreign operation in a financial statement. But again, how to translate a financial statement prepared in foreign currencies into a presentation of currency. Basically, International Accounting Standard number 21 answer two basic questions. One is, what exchange rate shall we use? But again, how to report gain or losses from foreign exchange rate in the financial statement. But again, let us discuss the function and the presentation of currency. What is the function of currencies? The function of currency is the currency of the primary economic environment in which the entity operates. It is the own entity currencies, and all other currencies, we regard them as foreign currencies. So for instance, if you are operating in Tanzania, you are using T shillings. So the T shillings become a function of currencies, and the other currencies will be regarded as foreign currencies. But again, a presentation of currency is the currency used to prepare a financial statement, and this we call a presentation of currency. And then normally, our function of currency and the presentation of currency are the same. The factor that the entity use, the factor for entity primary economic environment, what do we call a factor that determine primary economic environment? In most cases in the country where entity operate, but normally the factor which are considered as the following. The currency used that mainly influences sales price for goods and services. We call that is the one factor that give you entity primary economic environment. But the second one is the currency that we use it to pay labor, material, and the other costs. And the last one is the currency that fund from financing activities. So we are getting loan, we are issued share, and we get that currency. So that will be a entity primary economic environment currencies if it qualify to those three factors. But How are these recognized? Initially, all foreign currency transactions shall be translated into functional currencies when we are applying the spot exchange rate. The rate that exists on the date when the transaction took place. So we call that between the functional currency and the foreign currency at the date of transaction. So that is the initial recognitions. But the date of transaction is the date when the condition for initial recognition of an asset or liability are met in line of IFRS. But we have a subsequent reporting. A subsequent reporting, we mean at the end of each reporting period, you should translate all monetary items in a foreign currencies using the closing rate. But also all non-monetary items will be translated using historical rate. But if there is a non-monetary item measured at a fair value using the exchange rate at the date when the fair value was set. So the exchange rate differences. All exchange rate differences shall be recognized in a profit or loss with the following exception. That the exchange rate gain or losses on non-monetary item are recognized consistently with the recognition of gain or losses on item itself. Non-current asset should be recognized in other comprehensive income. But exchange rate gain or loss on a monetary item that form a part of reporting entity net investment in a foreign operation shall be recognized in a separate entity foreign operation financial statement in a profit or loss. But again, in the consolidated financial statement, initially in other comprehensive income, the subsequent in a disposal of net investment in a foreign operation, they shall be classified to profit or loss. For instance, if we take an example that Mamco Limited, situated in Tanzania, has the following foreign transaction. So we took an organization, but with some 4 transactions that time in year 31st December 2017. So you get that in November, they bought goods in a USD dollar from a Clean Limited. And they also is the same amount that will be used to pay a Clean Limited 120,000 US dollar. But again, on 15, the same 15 is sold good on US dollar 180,000 on credit to General Limited. And again, on 20, paid Clean Limited 120 US dollar for good purchased. So you can remember that on 15, we make a purchase on credit from Clean, and then on 20, we paid Clean 120 US dollar for good purchase. But again, on 20, we received this 60% on account from General Limited. Remember, on 15, we sold some good on credit to General Limited. But again, on 20, again, we bought motor vehicle for 200,000 on credit from Japan Limited. Again, on 20, we borrowed 270 US dollar from American Bank. And on 21st, we paid Japan Limited 160,000. And on 21st, also we bought good on credit from Clean Limited 90,000. So if you have these transactions and they are in a US dollar, but we keep our record with the Tanzania shillings, but the exchange rate of the relevant dates were as follows. On the same date on November, where transaction took place, we had the exchange rate, different exchange rate. On 15, $1 US were 2,100, and on 20, $1 US were Tanzania shilling 2,300, and on 21st, $1 US were equivalent to Tanzania shillings 2,400, and on 31st, US dollar is equal to, were equivalent to Tanzania shilling 2,600. So required, calculate the profit or loss on the foreign currencies to be reported in the statement of profit or loss on 30 March 2017. So again, this can be done. This can be done. Alternative one, we may use account for each debtor or each creditor. For instance, on a clean limited account, we may use an account having a column for US dollar and a column for Tanzania shillings. So on our clean, we make a purchase on 15, but those transactions were in US dollar, 120 US dollar. But if you make with the exchange rate, is the equivalent is 252 million. So again, on we make a payment on 20. Remember that on 20, our primary we are transacting with the Tanzania shillings. So equivalent, we make a payment of 120 US dollar, 120,000 US dollar, which is on the same date. If you take the exchange rate of that date, you find that it is a 276 million we paid to pay the same amount, which were equivalent to 252. So again, we make a purchases on 21st, 90,000, which is equivalent to 216. But on the closing date, we had a balance of 90, but the exchange rate is 2,600, so it's equivalent to 234. So this, if you make a closing balance, you will find out that we will have a balance, the exchange rate effect of 42 million, which will be the loss that is from resulting from changes of exchange rates. But if you take a general limited, also we make a sales of equivalent US dollar 180, equivalent to 378 million. We make a payment, we receive cash on 20, where we receive 60 US dollar, which is equivalent to Tanzania shilling 138 if you apply the exchange rate of that date, of that particular date. But again, the balance that is not yet received is 120 US dollar, but this, as from 31st, is equivalent to 312,000. So that will give us a gain of 72 million. But again, Japan Limited is the same. We make a purchase of motor vehicle on credit, so we debit motor vehicle, we credit Japan Limited account. But remember that this transaction is on US dollar, while we will be paying Tanzania shillings. So that amount, the same amount, we're equivalent to 200,000 US dollar is equivalent to 460 million on the transaction date of 20. But again, there is nothing, we paid cash, we managed to pay cash 160, which is equivalent to, we paid on 21st, but we paid 384 million. That gives us a balance of 40,000 US dollar, which is equivalent to 104 million. So again, if you make a comparison between a debit and a credit, you find out that there is a exchange loss of 28 million. Again, American bank account, we make a loan, debit bank and a credit American bank account with a US dollar 270, which equivalent to 60.21. But again, the same amount is due on 31st December. So, but the exchange rate is different from what were available on 20th. So this will give us a 702 million as compared to 60.21. So if you make a comparison, you found out that there is also a loss of 81 million. So if you combine the effect of exchange rates for each particular chance, you find that a clean limited will result to a loss of 42 million. Japan Limited will result to a loss of 28 million, and the American Bank will result to a loan of 81 million. But General Limited account will result to a profit on exchange rate of 72 million. So that in total, that will end up of a loss on exchange rate. So the exchange rate loss of 79 million. So that is alternative 1. The alternative 2, all these may be portrayed in a table. You may have a table, Clean Limited as a creditor, but again you have a General Limited also as a debtor, Japan Limited as a creditor, American Bank as a creditor. But again, you may have a table showing initial transaction in a US dollar that we have 120, 180, 200, 270. But again, initial transaction for each of them, you make a exchange rate with the spot rate, then you get 252, 378, 460, 621. Then at the date of settlement, we settled 120, but at the same date, the exchange rate were resulting to 276. And when we make a settlement that the data, so we collect money from the data, General Limited paid us 60,000. This one we are equivalent to 138. The Japan creditors get paid on 160, and this one we are equivalent to 384. So again, the second transactions, we make a purchase also 90,000 from a Clean Limited, which is equivalent to Tanzania shilling 260 million. So again, we take a balance at a closing date that we remain with the 90, we remain with the 120 US dollar. Japanese Limited, we remain with the 40, and American Bank, we remain with the 270, the same amount. So we take a balances at a closing date. At a closing date, we take a rate of that particular on 31st December. So that will be a closing rate 90 with the exchange rate 2,600. It will get 234 million, and General Limited will be 312 million, and the Japan Limited will be 104 million, and American Bank will be 702 million. Then we make whether we make a loss or profit when we consider the Tanzania shillings. Remember, if we take a clean limited, we have initial transaction in Tanzania shilling, we have a 252. But again, when we are paying, we paid 276 million. You can see that we have some losses made there. And the second transaction were 216 million. But now, as the closing date, the balances rose to 234. So if you take both two transactions, you get we have a minus of 42 million loss. And the General Limited debtors, also we have a 378 initial transaction, but they get paid 138 million, but we remain. So if you take 378 minus 138 million minus 312 million, we get that we have a profit. We make a exchange gain of 72 million. But again, Japan Limited creditor, if you take 460 minus 384, but we deduct also 104, we end up with a loss of 28 million. But American Bank, we have only a single transaction. They are not paid, but these 270 US dollar were equivalent to 621 million. But now the same amount, 270, because the exchange rate rose to 2,600, now it will become 702 million. So this gives us exchange differences of 81 million. So if you take losses of 42 plus gain of 72 plus losses of 28 plus losses of 81, this will give you a total loss of 79 million. So that is the two-way presentations of how you can present the losses that are obtained with the transactions with the other currencies. For listening.